If you suck at trading, if you suck at investing, it doesn't even matter. Let's just say you suck at making money. No, wait. It would probably sound better and cover all of our bases if we just agreed on agreeing that you suck at life. Stop trying to hide it and take the next 10 minutes out of your sucky life to turn things around for yourself. Because in this video, I'm going to be teaching you 3 simple strategies that you can use today to start making money in the stock market. And we're going to be starting right now. Hey, what's going on? It's Pat from Top Ticker Trades. If this is your first time here and you want to learn how to grow your wealth through investing and trading stocks in the market, make sure you start right now by subscribing and tapping that bell so you never miss a thing. I'll see you in the video. Let's go. What is going on, ladies and gentlemen? Welcome back to the channel. Welcome back to another video. I've got something very, very special planned for you today because today I'm going to be teaching you how to catch a fish. Well, not literally, but they do say that instead of giving a man a fish, teach him how to catch one instead, and that's going to feed him a whole lot longer. And I believe in that concept, so here's what I'm going to do for you. I'm going to be showing you how to develop a super strategy that will serve in protecting your position by minimizing and reducing any risks involved in your traditional trading and investing, as well as enable you to generate consistent profits, significantly reduce your cost basis when acquiring stocks, as well as being able to sell them immediately at a much higher price than the market value. If this sounds good to you, make sure you smash that like button, as it'll really help support me and it'll really help support the channel. It takes a lot of time for me to make these videos, and I'm not asking for money. I'm not sitting here with my cup out asking for change. All I want is for everyone to smash the like button and maybe subscribe here and there, okay? Thanks. So, first things first, what we're doing here, or how we're going to accomplish this, is through the use of simple stock options. Now, before you get all scared if, stock options isn't your thing, let me assure you that this will be quick and painless. It'll be a quick and painless lesson. You're going to know what you're doing by the end of this video. We're going to combine some simple strategies, some very basic level strategies, and we're going to turn them into that super duper strategy that I just mentioned. And it's going to do all that amazing and wonderful stuff for you. I did not just make all of that up. So please bear with me and give this thing a shot, and I guarantee you it's going to change the way that you invest and trade stocks forever. So first things first, you should figure out which of your stocks you're going to be holding forever, or at least the ones that you plan on hanging on to for, the long term. And by long term, since long term may mean something different to you than it does to me or anyone else, let's just say that we're talking about stocks that you are not trading at this time. In other words, you're keeping them. So once you've done this, and I'm assuming you're going to make some sort of list, the next thing that you're going to want to do is figure out which of these stocks you've got at least 100 shares of. Now, ideally, when you're buying stocks, try to set a goal of buying at least 100 shares. Now, obviously, not all stocks are created equal, which means that you're not going to be able to afford to buy 100 shares of every single stock that's out there. Neither can I. Here's what I want you to do about that. I want you to further refine the list that you just made by making a third list that's going to include all of the stocks that you don't have 100 shares of yet. And you're going to have 2 options to choose from. Number 1, you can continue to buy shares over time until you've acquired at least 100 shares. And so let me go ahead and address this part right now. It doesn't have to be 100 shares, but it does have to be in increments of 100 shares. In other words, 100, 200, 300, and so on. And the reason for this, since I haven't explained it before, if you don't know this already, When you're dealing with stock options, whether that's a call or a put, you're dealing with contracts. Now, each contract is equivalent to controlling 100 shares. So you're going to be controlling 100 shares no matter whether you're dealing with a put option or a call option, just off of one contract. And this, my friends, is what allows you to magnify the profits. But that's a story for another day. Let's continue on here. Through the use of my second strategy, you can also acquire your 100 shares a lot cheaper. But, there's always an exception. But you're going to need just a little bit of cash, okay? Whatever the break-even value is on that trade, that's how much you're going to need in your account as collateral. Don't worry about that for now. I'm gonna have to show you that when we get to the second strategy, but I just wanted to kind of throw that out there just to let you know that it exists. That's my favorite phrase to use because all my college professors used to say that crap to me when they weren't teaching me anything. Not implying that that's what's going on here, because I actually am going to teach you something. So we're going to put this list aside for now, like I just said, because we're going to be focusing instead on the stocks that you do own 100 shares or that you own increments of 100 shares of. And what you'll want to do here is pick one of those stocks that you're currently up on, okay? Preferably, you'll want to use this strategy when the stock is either overextended or if you're expecting it to go down. And another thing before I forget, what you need to know about this strategy is that there will be situations where you don't want to use it. And some stocks are more appealing to use it on than others. So remember when I asked you earlier to separate your long investments from your short-term investments? Reason being is that you can be more risky with your short-term stocks or the ones that you don't care about selling or being forced to sell. And as you'll soon find out, you're still going to be able to apply this strategy to your long-term stocks, but you'll want to play it extra safe, which means that you want to be able to profit as much as you would by using shares that you don't care about selling. But essentially, what we're doing here is we're going to use your position as leverage. So in other words, we're going to take your 100 shares and use them as collateral to make some money. Now, the best analogy that I can possibly come up with to explain the benefits of incorporating this strategy into your daily trading and investing routines is pretty much it's like renting out a house, okay, or renting out a property. Except in this strategy, you're not going to be dealing with all the inconvenient crap like renters that don't want to pay you rent or destroy your beautiful property, okay? In this strategy, you're basically buying shares of stock and then using them to profit, okay? You're going to be, I'm not going to say renting, but in a way you almost kind of are like renting, and you're going to understand this better when I break it down to you, but pretty much think of it in those terms for now. But specifically, you're going to be thinking of yourself as the landlord. You own an asset, and in this case, your asset is 100 shares of stock. And just as a landlord collects his rent money each and every single month, you'll be collecting rent on your asset, except you're not tied down to having to wait an entire month. You see, what's good about stock options is that certain stocks have options that expire weekly, monthly, yearly. I mean, whatever's available for the stocks that we're taking a look at or the stocks that you own. So what we can do is specifically target stocks that have weekly expiring options and a lot of volatility by buying those if we need to. Here's the catch though. The shorter the time frame that you choose to collect your rent for or your premium, by the way, we're going to refer to rent here as premium because to you, in the stock option world, you're actually collecting premium, not rent. But my point is that, the further out you go, the more money you get, the shorter of a time frame, the less premium you get, which kind of makes sense if you're thinking about it. But we still want to use the shortest amount of time possible, because your money or your shares are tied up in that position until this contract that we're selling actually expires. So with that being said, you're going to want to look for the sweet spot where the money that you're collecting is enough to make it worthwhile without, taking a year or two. And if you're not familiar with options whatsoever, you're probably wondering what strategy we're discussing. So let me go ahead and tell you the strategy that I'm referring to right now is simply known as selling a covered call. It is one of the basic strategies available through stock options. It's pretty safe and easy to use. Options consist of two components, a call and a put. So in very basic terms, calls are purchased if you're expecting the value of shares to rise or increase, and puts are purchased if you're expecting that share value to decrease. And you would purchase a put if you want to profit from the share price decreasing. Obviously, you're purchasing the call if you're wanting to profit from the share price increasing. So when buying a call option, you're essentially paying the seller of the option a premium in exchange for the right to be able to purchase, but not be obligated to purchase, the shares, which, remember, it's 100 shares, at the strike price before or on the expiration date. But if the share price does not reach above the strike price by the time the option expires, then the option expires worthless for the buyer, meaning that the seller keeps his shares and the premium received from the buyer becomes his profit. Now, 99% of the time, you'll want to be the option seller, as majority of all options purchased expire worthless. While selling a covered call is a great way to earn consistent profits, you do have some risk involved. The risks include capping your upside potential on the shares of stock that you are holding and being called out on your shares. Essentially, you would be obligated to sell your shares at the strike price if the share price were to reach the strike price before expiration. Keep in mind that a buyer can exercise the call at any time that the contract is in the money, and they do not have to wait until the contract actually expires. So that wraps it up with covered calls, and we're going to move right along and get into cash covered puts. Now, cash covered puts, this is an extremely effective strategy in allowing you to acquire shares of stock at a much lower cost basis and generating consistent profits. What makes this a really good strategy is that you're basically getting paid not to purchase the stock. And in the event that this doesn't work out for you, your risk is simply that you are required to buy the shares from the buyer of the put option. So what your goal ought to be is to do this with stocks that you don't mind owning. So for example, if you want to buy a stock, rather than going and buying it, just flat out buying the shares, what you need to do is sell a put option on it, one that will expire in the money, and then whatever premium you collected is what your discount will be. So for example, you're going to see that the break-even price will tell you whatever your new cost basis is, or whatever the cost basis will be with you doing it that way as opposed to doing it the traditional way. Now, if you're patient and you really don't care either way whether you get to own the stock or not, you're willing to own it, that's not a problem, but you're also willing to just get paid for not buying it. If that's the case, then what you would want to do is just sell an out of the money put, or any put that looks good to you with the proper break-even price that's attractive. So keep that in mind before you buy any more shares of stock. In other words, you're literally winning every single time that you do this. There are only two ways that this can play out. A, the share price does not drop below the strike price, and therefore you just get to pocket that premium without being obligated to buy the shares from the buyer. Or B, you buy the shares at the strike price that you agreed on and get them at a major discount. And honestly, that's all there really is to selling cash covered puts or cash secured puts. So we're going to move on to something a little bit more interesting, because here's where it gets very, very good. Even better for you, let's say that you buy 100 shares of stock at a major discount because you were obligated to buy the shares after selling a cash secured put. Now you can go in and turn around and sell a covered call on those shares, and you can sell the call at a lower strike price as your cost basis will be significantly lower than the current value at which the stock is trading. So selling a call at a lower strike translates into you collecting a lot of more premium than you normally would. It essentially means that you're selling above the current trading price if you were to get called out. So hopefully by now you're seeing the power of using options in your investing and trading strategies. But I've got another great idea for you, okay? I call this the double dip. So let's say that you're sitting on some shares and you're up quite a bit. You want to secure some profits, but you don't want to risk selling the stock and then it moving up again, only this time leaving you behind in the dust. So what do? Here's what I would do. First, you sell the shares. You take your profits. And second, you take that money and use it as collateral to sell an in-the-money cash-covered put that you believe will remain in the money at the expiration date. This will allow you to not only take profits on your shares, but also to get back in at a much lower cost basis. So this is why I call it the double dip. Pretty clever, huh? And if you thought that was clever, guess what we're going to do next? We're going to combine. That's right, we're going to sell a call on this that's out of the money if you're interested in keeping the shares. You got to keep in mind that, the closer you are to where that stock can get to as far as, price action goes, the more of a risk of you getting called out there is. But of course, you're still going to profit if that happens. You just may not profit as much as you would by, continuing to do so over a long period of time. But even if you were to get called out, it's not the end of the world. You can always buy back in and be, good to go. So don't cry. It'll be okay. Congratulations, ladies and gentlemen. You've made it to the end of the video. If you found this video helpful, I ask that you help this channel out by smashing that like button, as it motivates me to keep making videos just like this one every single day. If you're not a subscriber, you should consider subscribing, as I publish valuable content like this daily. You can do so from your screen right now, and if you want to check out more of my videos, you can click on the video that you'd like to see on your screen right now. Thanks for watching, and I will see you guys in the next video.